Hey everyone, I'm Norman Hathaway and I'm here with my partner Anita Bostok, and today we have with us mortgage expert Eran Obadia from Outline Financial here in Toronto.
We have a great webinar today. We are going to be discussing how to go into a competitive market because the market's heating up and Toronto still has very low inventory, and buyers are finding that again we're getting into the multiple offer situation. So Eran is going to help buyers to get their A game to be prepared for a multiple offer situation.
Thanks for having me, guys. Always a pleasure working with you guys, and let's fire away the questions and let's get our buyers better prepared.
Absolutely. So you've discussed the financial A game, and I think dealing with our own buyers, what we find is that going in on an offer night with a firm offer as opposed to having conditions, and particularly a condition on finance, is really important. So if you can help with some tips on what they need to do that, where they don't need to have a condition on getting their mortgage.
Right. So to start off, you would always want to start off with a pre-approval. All right. So in the pre-approval stage, we are vetting your income, looking at your credit, verifying your down payment. So we have a clear understanding of any challenges that might be presented right up front. All right. So if there is a challenge or a concern, then in some cases there will need to be a condition of financing. Right. However, that being said, what we try to do is minimize some of the risks of going firm. So your pre-approval will give you a clear understanding of what your maximum budget is. Your down payment ensures that you have sufficient funds for that down payment. Is there any wiggle room in that down payment? Okay. And then the credit, have we addressed any potential delinquencies? Is there a high utilization?
So utilization, you mean like a credit card or a car loan?
Right. So utilization really talks about their balances versus their credit limits. Right. So that would be addressed in the underwriting stage as well. You mentioned car loans. Yes, we absolutely need to factor those into the payment. So when we're giving you a maximum purchase price or maximum mortgage amount, we've already factored in those variables.
Mm-hmm.
We've talked about building a winning team. Eran, what are the advantages of working with a mortgage agent rather than with a banker, for instance?
Great question. So, your first advantage is accessibility. So, most mortgage brokers are available when needed, and when you're out there shopping with your clients, it's evenings and weekends, right? So myself, I can only speak for myself, of course, but I make myself available to my clients and to you guys so that if you're getting to a situation where you need to know your maximum purchase price on a Saturday night, I can be there, obviously, if need to be, right, and then help you out with that information. That's the first part. Secondly, when dealing with the bank, you have one institution, one product, one solution, one set of guidelines. When working with a mortgage broker, you have multiple lenders, multiple guidelines. So my job is to find the right lender, right solution that fits your client's needs. So if it doesn't work with one lender, it might work with another. Mm-hmm. And that might give us that additional wiggle room to help you with that winning bid.
And that's so important. We've had clients where they've worked just with their banker, for instance, and nothing wrong with a banker or a financial institution, but they have their rate, and we find out later that someone such as yourself could have come in with a better rate for them. And it's so important that clients know their options and can pull the trigger on the best possible thing they have available to them. So that's really important, and to be available.
It seems also that with banks, they do tend to work more than 9 to 5, but also they will look at the posted rate rather than other rates that are available. And can you just tell us the difference between a pre-approved mortgage and the the rate guarantee?
So, great question. So, a rate guarantee is literally just that. A bank's locked in a rate interest rate for you, and during your pre-approval stage, well, during your home searching stage, you get 120 days where you've got that peace of mind knowing that that is your maximum interest rate. Now, whereas a pre-approval is more than that. Not only have we locked in your interest rate and guaranteed your worst case scenario, we spoke about it earlier, we're vetting your documents. So I'm confirming your income as a lender would. I'm verifying your down payment as a lender would. I'm checking your credit, running your ratios as a lender would. So when you're getting into that shopping phase and you know exactly what you're qualified for, that is a pre-approval. Whereas a rate guarantee just locks in a rate and they'll look at the documentation later.
So the rate could be that rate, but it doesn't mean that that person qualifies for that rate, or they may qualify for something better.
They'll qualify for the rate, but that doesn't mean that they're qualified for that mortgage.
Okay.
Okay, which is more important for you than the rate, because the mortgage plus your down payment equals your purchase price.
And it's so important that you have the pre-approval, especially when going into a competitive bid situation on a property, that you can go in with the comfort of knowing you have that pre-approval already set up. So you don't have to have necessarily a mortgage or financial condition as part of the offer.
And you did touch on that a little bit about the vetting, but what are some of the pitfalls that you might see if somebody has a pre-approval and in that period they maybe are doing some things that they shouldn't be that may cause issues down the road?
Yeah, great question. So your pre-approval is a snapshot of the time of your financial situation. It includes, you're verifying of your income, as we said, so it's based on what you do, whether you're self-employed or you're salaried. Your down payment is based on your current assets and making sure we have the right history to show for it. And your credit is just based on what's your current trade lines at the time we pulled your credit. Now, few pitfalls. Number one, don't change your jobs. Okay, that is a huge one right there, because if you have a change in pay structure or if you have a salary reduction, that's going to reduce the amount that you qualify for. Second thing, don't take out a car loan, right? Because at the time of the pre-approval, we looked at your credit and there wasn't a car loan. And now all of a sudden there is. I can include that car loan into your calculation, and what you qualified before won't be what you qualify for now. And then same thing goes with just in general credit. Don't go on a crazy spending spree, because at the end of the day, a lender might very well pull your credit again at the time of the live offer. And if there's a difference, they'll want to know why. And that will also impact your approval. And then down payment, really simply put, you need that money. You need to allocate that money for your down payment and closing costs. Because that is a requirement. The lender needs to verify it, and the lawyer needs it at the time of closing. So if you go and you spend it, make a big purchase, once again, your down payment can shift. And if you go to, for example, if you were looking at $1 million plus, you need 20% down. If you all of a sudden don't have that 20% down, you're mandatory limited at $999.
Wow. Yeah. So that's
Because
that's
otherwise you don't get the CMHC, the mortgage insurance. Is that correct?
So if you have 20% or more, you don't need the CMHC. So if you're in the $1 million purchase or $1 million or more, you have to have the 20%.
Yes.
If you're purchasing something over $1 million and you don't have the 20%, you don't qualify, period. Because the cap to CMHC insurance is $999,999.
Right.
good point to remember.
And so that brings us to the budget too. Yeah, I mean, you have the down payment, but you also, first-time buyers especially, are not aware of all of the costs that go into the closing costs, which are the legal fees, land transfer tax, and in Toronto we actually have two. We have City of Toronto and the Ontario land transfer tax. There are adjustments, which say you're in a condo and the seller has already prepaid their taxes for the entire year. So that would be an adjustment back to the seller afterwards. But we also want to think in terms of other budgetary things, and these are things you would need to know about also, that what is the average cost of insuring the property? And anytime you have a mortgage, you don't need mortgage insurance, but you need fire insurance, because if you're getting a loan from the bank, they want to make sure that if something happens to that property, they're going to be covered at the end of the day. Right? Any other expenses you can think of that people need to think about?
Yeah, so you brought up some good points. So for qualification, so it's important to understand there's a difference between what expenses go into qualification and then what your actual expenses once you're living in the property. So the expenses that go into qualification are going to be your property taxes, maintenance fees, heating cost element, and then obviously the principal and interest of the mortgage itself, right? Plus all your car loans, credit card liabilities, etc.
All of the ongoing.
What other expenses that you will have as a homeowner or a condo owner that aren't included in the qualification would be expenses like home insurance or condo insurance, utilities that aren't covered by your maintenance fees, for example, like water, if it's a home, or heating or electricity. Other expenses such as like home life insurance, right? And some people want to protect their assets, protect their investments by having adequate life insurance or mortgage protection. That's not included in the qualification ratios as well. These are just generic costs to day-to-day expenses that you need to factor in when you're creating your budget to understand what you can truly afford. Because once again, what you can qualify for and what you can afford are two different things.
We don't want any surprises at the end of the day.
Correct.
Yeah.
So when you're thinking about making an offer on a property anywhere, and you may be facing competition, it's so important to have so many of these things wrapped up in your pocket, and getting advice from a mortgage specialist such as Eran to help you be able to go into an offer securely, knowing your financing is in place, that all of those extra expenses you are aware of, that you're able to deal with at the time. And so much of it comes down to determining how much a house would likely sell for, knowing your limits. And so it's important to have a great team that can help you determine all of those things.
And that's actually a really good point. How do we determine what a property is likely to sell for?
Right. So what do? Well, you hire agents that know what they're doing, right?
We look at what is already sold in the market, and the closer the property, a sold property is to the subject property or the one that you're looking to buy, that's where you want to be. You don't want to look at something a couple blocks away. It might be a completely different environment as far as, maybe it's in a different school district, or, property values are just higher for whatever reason. We want to look at all of the variables with that. We also want to look if, the most recent sale was 6 months ago. That could be a very different market than current day prices. So they could be higher or lower depending on what's going on with interest rates and other variable things, how much inventory is on the market. So we want to take a lot of time to look at that. But even so, sometimes properties do sell over the asking price, and sometimes by quite a bit. But this is where buyers want to be really careful, and they might get in the heat of the moment in an offer night. What can happen, Eran, when a property is sold beyond what a bank thinks it's worth?
Absolutely. So great question and very relevant question. So with every mortgage, one of the conditions of that are incorporated into every mortgage is appraising the property. An appraisal determines the property value based on comparable sales in the neighborhood of similar size usually within 30 to 60 days. The appraisers try to keep it within a more recent time frame.
Makes sense.
So what happens if that appraisal comes in under the purchase price? The lender will use the lower of the two prices. So appraisal versus purchase price. So what happens if the appraisal comes in less? The client needs to make up for that shortfall. So you asked me earlier, what do we do to prepare our clients for offer night in a competitive market? Well, one of the risk factors that I speak to my clients about is, what's your backup scenario? Do you have any additional funds if that appraisal comes in short? Could you get a gift from mom and dad, perhaps, who can make up that difference? If it's under $1 million, do you qualify for high ratio insurance if the property value comes in under that 80% value? Over that 80% value. So these are the conversations I'm having with my clients, so that when it gets into offer night, they understand all the risks involved. Once again, I will never be able to tell a client that you can go in firm, but I can certainly tell them when they cannot go in firm.
Right. So,
Good point.
and that's always, of course, so important to get guidance to help a buyer to stay within their limits and not overextend. And so having a team of people behind you that can help you on making those decisions, especially on offer night, is really important. And last but not least, coming from a seller's point of view, Eran, why is it so important that a seller receive a firm offer versus one with conditions?
Great question. So it comes down to understanding what a condition of financing is. A condition of financing is a time period that allows the buyer to determine with absolute certainty that they qualify for that mortgage. If they can't qualify for that mortgage, the buyer can pull out of the deal, get their deposit back, and then the seller would have to relist the property.
Right.
Or reach out to, I'm sure, maybe some of the other offers out there, right? But it's obviously an inconvenience to the seller.
Certainly an inconvenience and a risk, because if something were to happen such as that, especially on an offer night, they have to go back into the market. People may not be so inclined to bring the price up to where they had it in competition. So that's a very difficult situation. And they may have gone out and purchased another property. So it in fact can bring in legal ramifications as well.
For sure.
So it's a very important element to be able to confidently approach an offer with all of your strings.
All of your ducks in a row.
All of your ducks in a row. That's what I'm trying to say.
And you mentioned something earlier where if you're selling a property, so when understanding the risks of going firm, if you're relying on the equity of the property that you're selling as part of your down payment for the new property, and in a competitive market, you're buying before you're selling, what happens if that property you don't get what you expect to?
Right.
Do you have that shortfall to come up with? Right? Can you qualify potentially for a higher mortgage? Can you get mom and dad to help out or something of the sort? But that inherently is a risk, because
of course,
that down payment, that equity in your property is your down payment.
Yeah. So
okay.
Well,
I think we've covered a lot.
we certainly have.
And, hopefully the buyers out there will feel more confident once they've gone through all of the steps, and you can certainly reach out to Norman and myself and to Eran, and happy house shopping.
Right, and thank you, Eran Obadia, and from Anita and Norman, have a great day.